So good afternoon everyone. My name is Maurya Hanspal, and in this session we will continue our previous sessions talking about wealth management. So in the previous session we tried to understand what exactly do we mean by wealth management and why is wealth management so important. We tried to understand the different instruments of investments as well in our discussion of wealth management. Right. We talked about in very brief about the different instruments of investments. Like for example, we talked about the stock market, we talked about the bond market, we talked about the commodities market, we talked about the forex market. Also, we talked about the fixed deposits. Fixed deposits are ultimately not for the purpose of investments, but just for the sake of putting your money for the purpose of emergency. Like for example, like when we invest money in the stock market, we do not know that when the market will be on a boom or when the market will fall, or whether the market would be on a phase of consolidation. In that case, if you need some urgent money, your fixed deposits can help you to have that money. Okay, there might be some penalty charges, obviously, when you are like withdrawing your money from the fixed deposits, but ultimately it would be better than the stock market for the purpose of emergencies. So I do not say investing money in the fixed deposits. I say like putting money in fixed deposits for the purpose of emergency. Okay, and investing is a term which can be used for stock market or bond market or commodities market or forex market, because when you are investing in stock market, your aim should be to get returns or wealth maximizations. Okay, so that was something that we talked about. We also talked about that the returns on FDs or saving deposits, they really beat inflation, because inflation grows at an average rate of 6 to 7%. But these fixed deposits, they give you a return of like 5.75% to 6.25%. Also, the saving deposits or the saving account, the max to max give you a return of 3 to 4%, and 4% is max to max. Some new age banks might give you like 4.25 or like 4.5 max, but those traditional banks on which we rely upon, those banks will give you this max to max 3.5 to 4% return. So all these things we try to talk about in the session of the wealth management in the previous session. So these are the subsequent sessions on wealth management, and here I would be discussing something about the client and risk profiling. And what exactly do we mean by the client and risk profiling? So let's take a basic example. When someone is investing in the market, that person would be looking on his risk appetite, that how much risk the person can take in the market, right? So on the basis of that, the persons can be categorized into three types of people. And these three types of people have been talked about in the previous, like the wealth management sessions also, in stock market sessions also, in mutual fund sessions also, and fixed deposit sessions also. Okay, so I'll repeat the same thing once again. So when someone is investing in the stock market, or someone is taking advice from the second person or third person, that is when and how much to invest in stock market, so that person has to take care of his risk appetite. Now, like particularly when we talk about age I personally think is not associated with the risk appetite, because a large number of people think that the people who are a young age invest in the equity market because they have a more risk appetite, because ultimately those persons won't be having a large amount of kind of responsibility at that time. And a person who is in mid age, you're like late 40s or mid 30s or maybe in like late 50s or 60s, that person has some responsibilities and would be concerned about preserving his wealth, and that person would be allocating a large chunk of money in the bond market, because ultimately those fixed income security markets or the bond markets, on which again we have a separate session, they give you a fixed return and there is a lesser amount of risk. I won't say that there is no amount of risk, but a lesser amount of risk in the fixed income instruments. So an old age person, or a person who has reached a peak of his career and accumulated wealth, he might not take the risk of investing into the stock market. Like whereas a person can be a person who can combine both the equity strategy and the bond strategy, which people think as per the age. But I categorize them on the basis of three different aspects. One is the risk tolerant investor or the risk taking investor. The second person is the risk averse investor. And the third person in between, you have the risk neutral investor. Okay. So I'll just take you to the whiteboard and do the same stuff on the whiteboard as well. So when we talk about the risk profiling, or when someone is investing in the market or any of the market, be it the stock market or the commodity market or the bond market or the forex market or the crypto market, the category of the person can be divided into the three types of people. The first one is your risk tolerant person. He is also called the risk taking person. The second category, you have the risk averse person. He is the person who does not like to take risk in the market, or he can also be called as risk intolerant person. And the third person, somewhere in between, you have a risk neutral person. So firstly, when we talk about the risk profiling, or when you are investing in the market as per your own, so particularly here I'm talking about the market. I'm not particularly saying stock market or bond market or commodity or forex or crypto, because these persons might have some different aspects and some different goals or some different assumptions or the methodologies about the market. So that person might invest into different kind of instruments. Okay. So when we talk about the risk tolerant person or a risk taking person, a risk tolerant person is a person who likes to take risk in the stock market. He can be a young person, because a person in late teenagers or early 20s or late 20s or early 30s also, that person might not have so much responsibilities. At that time, he can take risk because at this point of time, he might not have time. उसके पास time नहीं होगा, but he would have energy to do so. A person who is young, a person who is in teens or early 20s or late 20s or early 30s also, like before 35 years of age, that person might not have time, but that person would have energy. And what do I mean by not having time and having more energy? By not having time, because at that time the person is trying to reach the peak of his career. The person is switching between the jobs. The person is accumulating wealth. The person is doing best in his career, acquiring more skills, knowledge, and experience, so that at a peak of his career, the person is mature and has a sufficient amount of wealth or corpus with him. That is why this person has no time. But since this person is young, he is not old, this person has immense amount of energy. Okay, so that is the scenario here. So if a person has energy and that person invests into the equity market, because this person who is a risk tolerant person will invest into the most risky instrument in the market, and that is the equity market. Because the equity market, it does not give you a predefined rate of return. It is unpredictable. You can predict it that when the market would rise or fall, but you cannot predict a sufficient amount of return on that. That's why the person is investing into equity. And even if this person loses some amount of his initial amount that he invested into the equity market, that person can work more harder and earn well. Because ultimately, this person has energy, he is young. He can search for more jobs, he can go for freelancing, he can go for alternative sources of income uh, apart from his job, as well as like popularly like what we call it in the present scenario as the side hustles and all. Okay, so that person can go for a new job, can switch jobs, can travel, can go for some good job opportunities, can earn some side income. So all these things can be there because this person has energy. And that is where this person is investing into the equity market. And even the crypto market can also come in at this place, because again the crypto market is very risky. The crypto market is more riskier than the stock market. Earlier we knew that the stock market is the most riskiest instrument, but now we know that the crypto market has come in, and the crypto market is 1,000 times more riskier than the equity market. Because ultimately when you are buying and selling shares in the equity market, you have the companies, and you can go and research about the companies. You can go through the fundamental analysis. You can see the profit and loss statement of the company, which is also called the income statement. You can go through the balance sheet of the company, which is also called the position statement. You can go through the cash flow statement, the statement of equities, the notes to accounts. You can read the management discussion and analysis report. You can read the auditor's report, like whether it is qualified, unqualified, adverse opinion or disclaimer of opinion. You can look into the CSR activities, ESG activities, the past investments of the company. How is the company growing and diversifying and expanding itself to capture the market share and the goodwill from the people? So these things can be undertaken through the fundamental analysis or any kind of research for these companies. But ultimately, when the cryptos are like coming up in the market, these cryptos are just not a legal tender also. These are just some digital assets which are being traded on the crypto exchange. Ultimately, these are not the companies. So these cryptos have no fundamentals and you cannot even predict. Some people have started to predict on the basis of technical analysis, but still this is something very risky which is least predictable. You might think that the market would rise the next day, the other day the Bitcoin might face a crash. So all these things can happen. So this person who is a risk tolerant person, a risk taking person, can take sufficient amount of risk in the market or more amount of risk in the market, and that person can invest into the stock or equity, right? The second thing when we talk about is the risk averse investor or the risk intolerant investor. The second category. Now, this is the second category of the risk averse person or risk intolerant person is a person who does not like to take risk in the market. That person is afraid of the market. So this person might have a portfolio of a bond. At least 80-25% would be in bond. As in the risk tolerant person or a risk taking person, it does not mean that this person would have a 100% portfolio as equity. But this person would have at least 85% of the portfolio. मतलब minimum 85% shares तो equity में होंगे ही होंगे. 90 भी हो सकते हैं, 100 भी हो सकते हैं, but minimum 85% होंगे ही होंगे. But when we talk about a risk averse investor or risk intolerant investor, that person is concerned about a fixed income or a fixed return where there is a lesser amount of risk. So this person might go for the bond market, or we can say basically we call them as the fixed income instruments market. A separate lecture series has been prepared on that also. We call them as a fixed income instruments market. You have the bonds, you have the debentures, you have the commercial papers, you have certificate of deposits, you have treasury bills, treasury notes, treasury bonds, even the fixed deposits as well. Though they will offer you a lesser amount of interest rate, because like when we talk about stock market, we talk about the return. But when we talk about the equity market, we talk about the return in the form of interest rate. They might give you a lesser amount of return in the form of interest rate, be it your bonds, be it your debentures or commercial papers or certificate of deposits, anything. And why are they giving you a lesser amount of fixed return? Because ultimately the basic principle of finance or the basic principle of stock market, one might say, higher the risk, higher is the expected return. Lower the risk, lower is the expected return. So in this case, in terms of the fixed income instruments, bonds, debentures, certificate of deposits, commercial papers, treasury bills, treasury notes, treasury bonds, all these instruments, even your fixed deposits, are giving you a fixed rate of interest no matter what. Whether the market goes in a period of boom or euphoria or in a period of like profit taking or recession or panic selling, will still get a fixed rate of interest. That is why your risk is reducing, not eliminating, but reducing. Because even the bonds can also default if the bonds are of a low graded company or junk bonds or a company like into bankruptcy and all. But that things are like something different. And if you want to know more about that, you can watch my lecture series on fixed deposits. Okay, so that is something different. But this person is getting a fixed rate of interest in the form of the return. So that person would be investing into the bond market because he is taking a lesser amount of risk. Now, since this person is taking a lesser amount of risk, he would be entitled a lesser amount of return as well. So that is one thing. So coming back to the risk tolerant person or risk taking person, a person who is risk taking, his goal might be growth. Like for example, if he has invested 1 lakh in the market, he wants 2 lakhs, 3 lakhs, 4 lakhs in the next coming years. He obviously doesn't want that the market would come down from 1 lakh to 50,000 or 40,000 or it remains constant or in a period of consolidation. And by consolidation, I mean the market, it does not rise or neither falls as well. It is in a period of a stagnant nature. Okay. So this person wants growth. This person also wants capital appreciation, growth of the companies, and if the companies are growing, they will have the capital appreciation. This 1 lakh might grow up to 1,50,000, 2 lakh, 4 lakh, 5 lakh rupees. That's one thing you should know. But this person who is a risk averse person, he might take into consideration the capital preservation and a fixed income. एक fixed income आती है. Now people say that a risk tolerant person or a person who is a risk taking person or a risk loving person, he is a person who is a person of the young age only. Whereas the person who is a risk averse person, a risk intolerant person, he is a person who is of the old age only. That can be correct, but not always correct. It basically depends upon the situations or the circumstances that particular person is facing. And what do I mean by the circumstances? So basically, it means that, for example, a person who is young, be it in 20s or 30s, That person might have some great responsibilities at home. It might happen that he has to pay off his some kind of loans, maybe the education loan, maybe the housing loan, or like some other kind of loan which his parents might have taken. It might happen that his parents are dependent upon him and they do not have a sufficient corpus to suit their like life of retirement. In that case, a person might not take a huge amount of risk in the market because he has to work for his house. He also has to pay off his EMIs for home loan, education loan, car loan, and all, and like all that stuff. And that person, and also in the initial days of the education or the job, the person might have a lower amount of salary as well. In that case, the person might invest a smaller amount into equity or invest like no amount into equity. That person might just invest into bonds. So whenever like someone is saying you that always invest into equities and do not invest into the fixed income instruments or do not invest into the fixed deposits also, they might be correct, but they do not look into your situation who is viewing the YouTube videos. They think about their own self and they talk about those people who have accumulated huge wealth in the market. They talk about Mr. Vijay Kedia, they talk about Mr. Rakesh Jhunjhunwala, they talk about Mr. Warren Buffett, they talk about Rakesh Jhunjhunwala, they talk about Charlie Munger, they talk about like Ramdev Agarwal. But the journey of those people were different. At an initial point of view, it might happen that you are not able to save that much, and you have to sustain for your family as well, build your own home, buy a car. So all these things might be there. In that case, you might love to invest into a fixed income instrument. At a later point of time, when your salary increases and you are at a good stage, you might start investing into equity as well. But that's a separate situation occurred at a later stage in life. Okay, so these situations can differ from one person to another. A YouTuber or any of the influencer or any of the teacher into the field of finance, they cannot force you not to open a fixed deposit account. Even some people, they rely on a fixed deposit account because the amount of salary that they're getting is too low, and they want a fixed return on the savings however they are able to get some. Okay, so you cannot force anyone. It is as per their own life. Okay. And people say that a person who is a risk averse person, he can be a person who is only of the old age person. We personally have seen people who are at the age of 60s or 50s or late 40s who still prefer to invest into the equity market because they might have preserved a sufficient corpus for themselves, maybe in crores or lakhs, and they might have some extra cash which they want to invest in equity market and want to take a slightly amount of higher return. So that situation can also happen. Though age should be considered, and even the financial advisors and the wealth management advisors also advise their clients that if you have attained the age of 50s and 60s, so do not take the risk of investing into equity market. But if like someone wants to invest into deliberately and has a sufficient corpus for himself kept aside apart from investing into the equity market, so that person can fully go on and invest into the equity market. Okay. So these were the two scenarios when we talk about the risk tolerant investors and the risk averse investors. Somewhere in between, you have a risk neutral investor. And what is a risk neutral investor? A risk neutral investor, it combines the strategy of both the risk tolerant as well as the risk averse. Now, this person is having a portfolio of both bond and equity market. Now, how can this be the portfolio? In the bond equity market, he can have like 50% into bonds and 50% into equities. Even this person can have 60% into bonds and 40% into equities. He can also have the vice versa, 40% in bonds and 60% into equities. But this minimum criteria of 85% won't be there. When you have 85% of the equity in your portfolio, you become a risk tolerant investor. But when you have minimum 85% of the fixed income instruments in your portfolio, you become a risk averse investor. But this person has either a 60-40 ratio, a 40-60 ratio, or 50-50 ratio. Now, this person is concerned about combining the strategies of both of these, and he might be in the age group of like mid 30s or mid 40s, but age group is something different, which I believe. The perception, the market understanding, and the conditions, both physically, mentally, and emotionally, the person is facing is more important into this scenario. So, this person wants both the capital appreciation and growth from the equity component of the portfolio and the capital preservation and the fixed income from the debt component of the portfolio. So basically, in crisp and in very short, a risk neutral investor is trying to have both a risk tolerant as well as a risk averse investing strategy. A risk tolerant one is also called an aggressive. strategy of investing. You might have heard about aggressive portfolios or aggressive investors. These are those investors which invest minimum 85%, 80 to 85% into the equity portfolio. You also might have heard about the conservative investors. So when we talk about conservative investors, these are those investors which invest a large proportion into your bond market. And here you have the moderate investors, which are somewhere between your aggressive investors and conservative investors. You have the moderate investors. So that's something also you can take into consideration. So these three types of investors must be known to you. So coming back to the sheet, to the PowerPoint presentation. So see, like whenever you are doing anything, okay, you have to see that what is your primary goal for the funds invested through. That for what purpose you are saving the money. It's periodic income or long-term capital appreciation. Are you saving money into the bond or like into equity for the retirement funding or for the purpose of education or like major purchase? So all these things are present when you are like investing in the market. Okay, even you have the equity portfolios and even the bond fund as well are present in the market that suit you for the purpose of retirement planning. They might have a lesser amount of risk, but they help you for the purpose of retirement planning also. They help you for the purpose of a child education also, for marriage purposes also. And we popularly call them as the solution oriented schemes. At this right time here we call them as the solution oriented schemes. That they're here to solve a particular solution. Solution oriented schemes. Yeah. Those are called popularly as the solution oriented schemes. Okay. So this you should know. That you need to specify your income objective, that what exactly is your income objective. You need to see that to preserve capital and generate income. Now, to preserve capital and generate income, we talked about the capital preservation and having a fixed income in return. And that's a strategy for the risk averse investor, the risk intolerant investor who invests in the fixed income instruments and does not want to take a huge amount of risk in the market. The second one was to generate moderate capital growth with your income. To generate long-term capital growth, no need of regular income. It can be a moderate investor because this person wants a not very high growth, but a moderate growth in the capital. It means he's following the strategy of both the capital growth and conservation, but he's not in concern of wanting a regular income. The third category can be to generate aggressive capital growth over the long term and no need of regular income. Now, this person is just concerned about to generate aggressive capital, and this person just wants growth. So this can be the case of an aggressive investor. Okay. Now, the third thing the person has to take into consideration is there a near term, less than 3 years need for any part of the portfolio for other purposes? If you need some near term amount, then equity might not be a good alternative because if you want money after like 1 year, it might happen कि 2 साल तो कोविड में निकल गया and market नीचे गिरी हुई थी, या some kind of recession आ गया, या फिर रशिया यूक्रेन के आके crisis, and at that point you want the money. So for like very short term, the market for equity is not good. In that case, the bond market is more beneficial. Yes, if yes, then what percentage of this portfolio do you expect to withdraw within the next 3 years? It might happen that you have invested 100 rupees in the market, and you might think कि first year में like you will take out 20 rupees, second year में 30 rupees, and side by side तुम investment भी कर रहे होगे, ठीक है? So that is the other scenario. That my past investments includes and for how many years I am investing into these. What is your time horizon for investment? That is like you are investing for 5 years or 6 years or 7 years, and for how many years? बैंक फिक्स डिपॉजिट्स या पोस्टल सेविंग्स में कर रहे हो, बॉन्ड्स या बॉन्ड म्यूचुअल फंड में कर रहे हो, इक्विटी म्यूचुअल फंड में कर रहे हो, प्राइवेट इक्विटी, रियल एस्टेट, इंटरनेशनल इक्विटी बॉन्ड्स, ऑल्टरनेटिव इन्वेस्टमेंट्स, टॉलरेंस फॉर रिस्क एंड वोलेटिलिटी, किस चीज में कर रहे हो? सो ऑल दीज थिंग्स आर अगेन वेरी इंपॉर्टेंट व्हेन यू आर फ्रेमिंग योर गोल. Okay. Then they ask the further risk profile questions also. Have you borrowed money from anyone, any loan, or like what are you planning to do? So all these things also have to be taken into consideration while doing all this. Then the self-investment, like up to like 0%. See, if you are like investing 100% into a growth fund, a complete equity fund, it's called a wealth builder allocation. If it's 75%, it's an enterprising allocation. If it's up to 50%, it's a balance allocation. And balance क्यों, like 50% equity हो गया and 50% debt हो गया. अगर 25 में है, it's a conservative allocation. And अगर zero equity है, completely debt, it's an ultra conservative debt allocation. So what do we call it? Ultra conservative debt allocation. Okay. So that's all for today. Like we'll talk about